Welcome to this week's episode of the Real Wealth Podcast. This week I'm joined by our social media manager here at Red Group, Gordon. Gordon, welcome to the podcast.
Thanks for having me on. It feels a bit weird being on this side of
This side of the table is usually creeping about behind the camera.
but it's good. You get to listen to some insightful conversations. Hopefully this can be one of them. But
this has been a really great year, and we've had a lot of really cool guests so far. I'm loving what we've been doing on the podcast and getting to speak to some really interesting people. But it's good to have an opportunity to sit down and have a one-on-one with you and talk about some of the things that we've covered over the last 2 years in the Real Wealth Podcast. So I'm going to be handing over to you for this podcast, and you can fire some questions across to me, and I'm here to take them.
yeah, no worries at all. So today I really want to discuss investment opportunities with you, just to get more of a broad understanding of it, to be honest. Something that I wouldn't really say I'm clued up on personally, maybe not as much as I should be, say. I've got a Hargreaves Lansdowne account I put money into every month, but I just want to get a broader understanding, really. I started listening to the Dave Ramsey show recently, and one of the things that he mentioned which really stood out to me was this idea that $100 invested every month, from age 25 to 65 is just over $1 million. Now, obviously, he's speaking about the Roth IRA, which is averaging 12%, but it kind of surprises me that nobody really speaks about that enough, that you could retire a millionaire. Why do you think that is?
Well, I think, a lot of people are kind of sceptical when they hear about things like that, because they don't, one, understand the power of compounding, and two, think that 12% annual return is unrealistic. But all you have to do is look at the S&P 500 from the 1950s. The average return is over 11% per annum. There are going to be big swings year to year, but the important point is long-term investment. And the sooner and younger you start, the further you can go with that investment. This all comes back to the fact that there's very little education about financial well-being and wealth creation at school. There's not a lot of incentive for the government to do that. They're only interested in you out there working, paying your taxes. The longer you work, the less they have to support you. So if you're not in a position to retire at 60 and you need to keep working, that's not necessarily a bad thing for the government, because you're still productive in the economy. It's not so good for the individual, because they're working till their dying breath. So there definitely has to be much more conversations about how the power of compounding can create an extreme amount of wealth with an amount of money that you're not really going to miss that much. I started putting 100 quid a month into a Vanguard account for my kids. And I know by the time that they're sort of 21, by the time they'd like to access it with the expected returns of the S&P 500, it should be about 70, 80 grand, which is a really good start for them. And it's not an amount of money that I'm going to miss every month. I fully buy into that concept, and the more people that know about, ultimately starting as early as you can. If we kept that fund going for the kids, they could retire, in their early 40s, probably before that,
It's one of those ones, though, it goes back to education. In school, you're really taught English, maths, French even, but nobody tells you about the stuff that you actually need. Nobody tells you or teaches you about how to get a mortgage or how to have that conversation. Nobody really teaches you about a pension in school. So it's mental that, we're having all these people that are skilled coming through, but when it comes to simple things like buying a house or buying a car, nobody really knows what they're doing unless they're doing that research themselves.
Yeah, it is bizarre, and I spoke about this in a recent podcast where I really feel like the three most important things for a successful life you're not taught through school and through younger education is money, mindset, and love. How to understand finances, grow wealth. Money is not the be all and end all, but it can make you very unhappy if you don't get it right, and so many people don't get it right. Mindset, again, having a happy, healthy mindset, understanding the fundamentals and human nature, and the fact that we can take ourselves down these routes of depression, but most of it is in our head. Anxiety, a lot of the anxiety comes from being too focused on what might happen in the future, running 100 different scenarios through your head that haven't happened yet. And the more that you can live in the now, the happier your life can become. And then obviously the final one, which is love, and getting into the wrong relationship can lead you down a very unhappy path. But nobody's taught how to pick a partner. Nobody's even taught how to become the person that they want to attract. The fundamental principle that if you want all these things in a partner, you have to start from being able to have those things in yourself and get yourself the way you want to be before you can attract the right partner. And it just bonkers to me to think that someone could pick a partner in their late teens, early 20s, and that would be them for the rest of their life. You become so many more different people throughout your life, so probably should be an age limit on being able to make those sort of decisions. But I mean, money's massive. Spoke at length in the podcast that there needs to be much more education on finance out there, and this is one of the main reasons behind the podcast.
I think it was the Mark Laurie podcast, you mentioned it, and it was about, the school system just cutting these diamonds, or cutting you into a diamond. Yeah. But it's like a massive part, as you've just said, missing out, and I think that's why a lot of sort of young people, or the younger generation, are mismanaged their finance, really. I read a quote the other day there, and it was, if you want to waste £5,000 a year, spend £13.70 a day on things you don't need. Yep. Now, that seems like a challenge. It used to be really hard for me living out with my means, and I didn't have a budget for myself. But maybe in the last year or two, I've really started to think about it, since getting the house, with the wedding coming up, etc. £13.70 with the cost of living's at a lunch now. If I forget my lunch one day, that's a punishment. Yeah. And it really makes you think, if that's £5,000 a year, what else are you wasting your money on? So, see, in your eyes, what are some of the key principles or strategies for effective long-term investing with the cost of living increasing every year, would you say?
I think, to start with, the point you make about wasting money day in, day out, it doesn't seem like a lot of money to spend a few quid here and there that you don't feel you need to. But again, long-term investment is always about understanding the compound effect of that. If that's £5,000 a year that you wasted, that you've not invested, that £5,000 could become millions of pounds over the course of your life if that had been invested annually at good return. And would it have affected the quality of your life not spending that £5,000? More than likely not. So it's the small decisions that people make in life that accumulate to where they end up, and it's just unfortunate that a lot of people in their early years are almost encouraged to take on debt as a starter. You go to university, you're encouraged to take on student debt to get through university, to pay yourself through, even in Scotland where you don't necessarily have to pay a lot of fees to go to university, you still have to live. So there's all those student loans that you rack up. Getting your first house, you're taking on a big mortgage. There was points in time where they were encouraging you to take 100% mortgage on your first house. I think those options are back now, where you don't actually have the money to buy the house. You're just leveraging a massive deposit. That's fine in a growing market, but you hit a bubble in the property market, and you're in negative equity. You're in a real mix. Happened to so many people in 2008. Credit cards are made available to guys that are like 18, 19, 20. It's just encouraging you to go out and party and spend money on clothes that you don't have. There are not a lot of opportunities for learning and growing at that age, but there are a lot of opportunities for getting in debt, and it's a start of a cycle that can lead you down a really sticky path in life. So to start with, that's unfortunate, and certainly something that we're trying to get the word out on. Secondly, back to your original question, which was what makes for successful long-term investing, right? I mean, I spoke for so long there, I just want to check I remember the question. Yeah. The most important word in that question is long-term. We've already talked about the power of compounding and the fact that, the longer you have an investment that's invested well and growing the more wealth you can generate, and wealth creates wealth. You know, when your interest from last year now becomes your capital that's earning you interest this year, you see how compounding works. So the most important thing about it is long term. And a lot of people talk about, you know, investing as, you know, do nothing. You know, you make an investment decision, you park the money, and the best thing you can do is just forget about it and let it grow. And I think with a lot of investments like, you know, S&P 500 tracker funds or whatever, where there has been, you know, very strong historical evidence over a long period of time that you will get the returns in the long term, that can make sense. Because if you're messing about with your investments all the time, you're moving stuff here and there, that's not really investing, it's trading, for starters. And secondly, you can accrue a lot of transaction fees associated with that, so you're destroying your wealth to be moving it around. So a lot of the best long-term investments are just that. They're long-term, where you're looking to put your money somewhere for a long period of time and just allow it to grow without really messing with it too much. Diversification is something that's spoke about a lot in terms of investments. Spreading your risk, you know, whether it's geographical spread or different types of investments. Obviously, there is always the risk that one area goes down. You know, if, you know, things like gold and silver tend to do well in a relatively bad economic cycle. So you might see equities are you know, getting hit because it's a bad economic cycle, but gold and silver are doing really well. That's the benefit of diversifying and kind of trying to balance things out, so no one thing can kind of wipe out your investment, you know. And that makes a lot of sense, perhaps not at the start so much, but as you get on. And it's another really important point about long-term investing, is understanding from the start what your objectives are, what your goals are, what you're trying to achieve. When you're younger, you can afford to take more risks. You can afford to look at much more risky investments. That comes with the downside that, you know, generally in your younger years, you don't have the level of knowledge and understanding to be able to take those risks in a well planned out and thought through way. But you can afford to take the hit of losing all the money. You know, if you're looking at something like crypto just now, there has been some incredible returns in crypto. However, it's massively risky. You know, maybe not so much now in terms of Bitcoin, but the fluctuations are still huge, even with an established crypto like Bitcoin. But you know, if you can afford to put in a certain amount of money in your younger years and lose that entire money, you can effectively take bigger risks and look for bigger returns in the short term. As you get closer towards retirement age, you want to wind back on those risks. You want to invest in things that are a bit more solid and less likely to fluctuate greatly. So again, it depends where you are in your life, what your goals are, you know, what the long-term goals of your investments are. Quite a lot of people are not looking to get super wealthy.
No,
you know,
no.
They're just looking to make their life comfortable. They're just looking to make sure that they can retire with a decent amount of money, that their children are well taken care of, and they can have the basic things in life that they need. And if that's your objective, then you don't have to look at massively risky, you know, investments. Investments for us, you know, Laurie and I really got into sort of the investing game, certainly in terms of property investment and building our businesses in our 30s, when we were settling down, when we had kids, when we had a mortgage. There was only so much risk we could take at that point because we had a life to live. You know, we had responsibilities. You know, you don't have that in your early 20s. So if you're going to, you know, build your own business and take risks, your 20s is the time to do it. It's really difficult to do it in your 30s. You know, we had to build our portfolio to a point where it could sustain us before we could leave our full-time job, which meant doing 2 jobs for quite a long period of time. And then even then, the risks that we take in business have to be calculated, because we can't afford, and now near 40, to go back to square one again, you know. And that's at the higher end of investment. When you're building your own businesses, you're putting money in to create something new, which has massive upside potential if it lands, but significant downside. You really can't lose it all in those instances. it's figuring out the right time in life for you to be able to do that, you know.
No, I agree with that. I think as well, just going back to what we were talking about at the start of that question, I appreciate that was maybe a long question to get.
Well, I think there's still a lot of other things, you know, to be said on that. Another thing is, you know, whether or not you're interested in what you're investing in. Now, that could be a plus and a minus.
Yeah.
Because if you're really interested in it, then you're more likely to fuck with it, you know. Whereas if you're a bit removed from it, like, you know, just sticking it in a tracker fund, you know, you're just looking at the financial numbers. But if you want to go in a more risky route where you're more trading than investing and trying to grow your assets, and then you have to have an interest in what you're doing. So it's balancing those things out.
Just kind of pointing something out to me about how easy it is to get into debt. And, you know, you look on closing sites now, you've always got the actual price, then you've got Klarna right down the bottom.
Yeah.
That's offering 3 or 4 payments a fortnight to get that thing that is £120.
Well, there's been a few kind of viral posts going out about businesses like Sports Direct that have got like a pair of shoes at like 60 quid and they're offering finance on them at 30% APR. Yeah. You know, you're just encouraging people to get in a hole and buy things they can't afford. It's such a hard lesson to learn, and you know, it takes, again, this goes back to the whole mindset thing. It takes a lot of mental training to be able to say, you know, I'm not going to be suckered in by this stuff. I know what they're doing here.
Yeah, the car payments as well in ours, the big one that I've noticed. You know, people with these just luxury cars that are actually, you know, we're not talking Ferraris or McLarens, we're talking, you know, Audi, like simple model Audi, and it's like people are paying hundreds a month on that car that they don't own. It depreciates in value at the end of it. It's a mental...
It's a liability, and if you go back to the teachings of Robert Kiyosaki, you know, you create the assets first that then pay for the liabilities. You know, you're not... You know, if you just start racking up the liabilities because you've got a job, you've got a bit of income, and you think, oh, well, you know, I want to be seen to be doing well, so, you know, I'll get this car that's wiping out half my income every month. You know, you're on a slippery slope. Whereas, you know, if you can sacrifice for a while, delay gratification, which is the thing that most people struggle with now in a world of finance, delay the gratification, build the assets, and then the asset pays for the car. You know, I mean, all of our vehicles are through the business now, and the business pays for them because we built it to a point where the cars didn't come first, the business did, you know.
What do you think some of the common misconceptions or barriers are you think people face when it comes to investing for their future? Do you think it's just a simple case of right now they're living on more than what they make, or do you think there's more to it, would you say?
I think fear is a big part of people's reluctance with investment. Everybody's got a story about how someone they know lost out on doing this thing, and you know, and those stories are real. Like, you know, don't get me wrong, investments go wrong all the time. You know, I have friends of mine that lost 200 grand to a crypto scam. These things happen, but fear drives lack of action, and lack of action can be probably more dangerous than anything. You know, if you're sitting on a bunch of cash in your bank account and you're scared to do anything, the first misconception is, you know, that money is safe there. Not really. Most banks are only covered up to about £85,000 if they go into, you know, if the bank goes down and you've got 100 grand in there, you're losing some of that money. The bank is taking your money and leveraging it massively, lending it out to people. You know, the banks have a ability to leverage your money to 1 in 10. So your 100 grand becomes $1 million that they lend out. So, you know, the riskiness of money sitting in the bank is massively underestimated, and the return you get is minuscule when you compare that to inflation over the year. You're losing money every year. You know, the value of that money is decreasing every year. So inaction can be one of the most dangerous things, and it's driven from fear of making a mistake. biggest mistake you can make is doing nothing, not investing. So I think fear is a big driver. I think too many people think short term. Again, it's this concept or difference between trading and investing. And a lot of people think if they need to get into stocks and shares, that they need to become an expert in all these different companies and trading every week and managing their investments. And it doesn't have to be like that. Investment is normally, and certainly in the world of Warren Buffett, is back a horse and see it through the long term. It's not dipping in and out of companies or making a quick turn. It's about seeing the underlying value in something that you want to invest in and holding it for the long term. We've got the same issue with clients in property investment, is understanding that property investment is not a short term game. Now, you can go into property trading and flip properties and make a quick buck, but you're going to be taxed heavily. You're dependent on the market, whether or not you can sell it. But buying property to hold it for the long term and rent it out to tenants can become very, very attractive. If you've got a few properties at the start and it seems like a bit of a slog and you've got an issue with a tenant, fast forward a couple of years when you've got 20 properties, your cash flow is several £1,000s a month on a net basis where you can displace your income. It can become life-changing. But it's a lot of work in the front end, and you're going to have to deal with valuations not going your way, lenders pulling funding, you're going to have to deal with tenants not paying the rent. The short-term pain of it is a challenge, but the long-term benefits, when the capital starts to appreciate, when you've got a low LTV, when you've got a great net cash flow, and you've got us over 200 properties, and if a tenant or two tenants don't pay the rent, it's not going to affect us that significantly. So it's long-term view, avoid short-term thinking. Too many people want to mess with things too much. Procrastination as well, the guys that just spend time looking at all these different strategies and get what we would call paralysis by analysis. There are so many things you can invest in out there. Look at the amount of things we've covered so far in the podcast, from whiskey to crypto to gold and silver to trading to property, and that's without getting into the more niche stuff like investing in watches or classic cars or paintings. There's so much you can do, and it can feel overwhelming for people. But I generally just say, work backwards from what your goals are. What are you trying to achieve? What level of return do you need? What level of cash can you put into it on a regular basis? What is the end goal? What is your risk appetite, and how much risk are you in a position to take? How much of a loss could you sustain if it didn't go your way? And what interests you? And once you've answered all those questions, you can start to narrow in on how you want to invest. And that's the thing about investment. In this podcast, we're never going to say this is how you should invest your money, because it's a very individual answer. It's completely dependent on your circumstances, your situation, the position you're starting in, the position you want to end in, what interests you. There's no one size fits all with investment, but those are some of the most important questions that you need to answer. A lot of people as well, another form of procrastination is like saying, yeah, I'm not going to get a property just now because the market's not good. Or, I think the market's going to take a dip in the next 6 months, so I'm not going to get in. Generally, with most investment, the best time to start is now. The best time to start was 10 years ago. The second best time to start is now, because again, the sooner you're in, the value of compounding, the better it is in the long term. And property investments is one where we hear that all the time. People saying, "Oh, it's not a great market just now. Property's not selling. I don't want to get involved in property." That's the fucking perfect time to get involved. And it goes back to the old adage of be fearful when others are greedy and be greedy when others are fearful. When the market is on its arse, it's the time to get in, because you will get some great deals and you can benefit from the capital appreciation further down the line.
I think as well, you've kind of just touched on it there, but it's more, you're hearing excuses for people of why they're not wanting to invest right now. Mm-hmm. Or, what I see a lot of as well is negativity. We're going to touch on side hustles just in a bit, but more to the point, since obviously I've got my own sort of side hustle on the go here. And even I get people saying to me, you know, as well as it's a good thing, you know, I'm creating a second income for myself or whatever, I hear a lot of people say, aye, but you're going to get taxed on it. And it's like, yeah, but that's just part of life. And it's what you're saying there is, you know, there's always somebody that's going to have a negative.
Who's going to pull the negative on it. And you know, again, it just comes from people become uncomfortable when others stretch out of their comfort zone, when they're doing something that moves themselves forward. You know, that can make a lot of people around you nervous, that just want everybody to stay in their box, and if we're all in the same box, then we're all happy.
Yeah.
So you need to see through that, and to that specific point of you need to pay tax. You know, there is no more flexible tax system than having your own business. And structuring your tax in the most tax efficient way. As an employee, there's fuck all you can do. You're on the PAYE system. The money is taken before you see it. There is no tax dodge. There is no tax efficiency, tax avoidance strategy. When you've got your own business, there's so much you can do. There's so much flexibility. So actually, you can make your overall tax situation much better by having a side hustle.
No, definitely. What I say side hustle, but it's really secondary income. And you know, we work with a lot of different people for different backgrounds here at Rood. And one thing that I've been speaking to people about, you know, sometimes they mention, certainly when we're talking about getting them active on social media and stuff like that, they mention their company's frustration with them. You know, I don't know if it's an excuse, I don't think it is, but they say, you know, I work in finance, so my company wouldn't be happy with me, you know, doing this. Do you think it's frowned upon by companies? I get it in some circumstances. You know, the media team that I used to work with in one of my previous jobs had to sign something because there was a commercial interest at stake. Yeah. But do you think with something like what we're doing here, do you think it's frowned upon by companies? Because it's a dangerous rabbit hole to go down, that your employer is against you creating that secondary income for yourself.
Yeah, I think it's certainly the more corporate the company is, the more likely that they're going to have rules and regulations on it. I think it's a bit of an overreach for a lot of companies to say that they have to have a say in what you do out with your working hours. So yeah, I really don't like that, but I do understand why that becomes an issue for a lot of companies. You know, when we started Root Group, I was very careful because I was still full-time employed in what I posted and where I posted it. But after a while, I realised that the company just really didn't care. But it's not to say that all companies would be like that. I mean, I guess there could be concerns from a conflict of interest if what you're doing as a side hustle is, you know, part of the reason why you're employed with them. You know, so, you know, are you leveraging their existing clients to get access to something? Are you, you know, there could be a variety of reasons why they would be concerned if it was in the sphere of what your employer does.
Of course.
You might have in your employment contract certain restrictions, anti-competition legislation and things like that you have to abide by. So you do have to tread carefully on that sort of stuff, because you never want it to become a situation where your secondary income becomes your only income. Yeah. Because your employers. But you know, there could be intellectual property concerns, again, if you're working in the same sphere and you're maybe using some of their documentation or information. Risk of burnout, I suppose, you know, if you're working, you know, 18 hours a day because you're doing 8-9 hours for your current employer and then a shitload more on top of that. You're not for yourself. 100%. You're not able to give 100% because you're burnt out. There could be liability issues as well, you know, if you are a face of that organisation and they, you know, you're seen to be out there representing something else. Again, it's sort of a conflict of interest where they can say, well, you know, this guy is a key face in our business, but he's also over here doing something else which may not align with the values of the company that you work for. And it can create a culture that a lot of big corporate companies don't like, where you know, they want you bought into their company, they want you to be bought into their vision, and if you're kind of effectively in their eyes planning an exit route, they're not going to like it. So it's a really difficult one to tread. A lot of our clients have got that sort of issue where they've got an employer, they want to get out there on social media and start talking about their property investments, but they're a bit reluctant to do that because they don't know how the employer is going to react. Mine was good. They didn't care. You know, as an employer here, we obviously encourage our staff to be entrepreneurial and do their own thing, insofar as it doesn't affect, you know, their ability to do what they do here for us. And, you know, again, it's like, if you can't get your staff to buy in to your vision and want to be on board for the long term, then you're not doing something right as a business owner. So, you know, if you're fearful because they've got a side hustle that they're not bought in, then, you know, they're probably not bought in and you've not done what you need to do to get the buy-in. But yeah, you're right. Yeah, it definitely is a big talking point for people that are got their side hustle or second income. You know, treading carefully with the existing employer is something that you need to do.
Yeah, definitely. I listened recently, or this morning even, I listened back to that podcast you did with Ryan, and it was like the last sort of Ask Me Anything one that you did. Yeah. I think that was the first podcast episode I listened to before I joined.
Before you joined us.
Aye. So that kind of sold me in. But no, obviously the difference then was compared to now, the podcast has grew quite a bit. You know, we've had multiple people, and you mentioned some of them there. Don and Deck for Crypto Glasgow, certainly really interesting guys. Julian with the whiskey, Sam Kavanagh with trading, Scott McClure e-commerce, etc. So now, I think you said, you know, that was the point of the Real Wealth podcast, was to get more insight onto different investment strategies. So after listening to all these guys talking, they're all quite similar minded, I would say, but you know, they're really creative guys. What would you say has been one that you could say for yourself, you know what, I would quite like to invest in that, or I would recommend that to somebody else?
I think what's interesting about the point you make there is, even although a lot of these guys that have come in are in very different spheres of investment and wealth creation, you do see some commonality between them. That entrepreneurial streak, the dedication. I've never met so many people that don't drink, that exercise, that you know, understand the key concepts of mindset, that have read the same books and done the same things, because there are certain fundamental elements that are critical to success, and getting your head right, as I said at the start with those three things, getting your head right is a massive thing. So even although these guys are in totally different fields, you can sense the similarities between them in the way that they live their life and the way that they approach the work. You know, this is not a job for them. It's a way of life, and they don't necessarily separate between work and play or work and life. It all comes together, and you know, it's not to say that work becomes your life, but it's integral to it. It's something that lives alongside it, and it's not a job. It's not a 9 to 5. It's something where they'd happily jump on and do work at 10 o'clock at night because they love it. But equally, they'll be able to take the time back the next day to go to the beach. You know, so I've loved seeing the different types of investment strategies, the different types of guys that are really smashing it out there. But you know, also see the underlying commonality between them. In terms of investment that I would do myself, it's hard not to be attracted by some of the gains that we've seen in cryptocurrency over the last little while. I believe in the concept behind crypto, albeit, you know, you have to note that there are a lot of coins out there that are trash or don't have any real purpose. But the principle of making money more transparent, making it more tied to a restricted thing, you know, Bitcoin being like there's only 24 million of it, you know, goes back to the concept of gold, and our economy performed at its best when the currency was tied to the gold standard. As soon as we took it off, it's been a gradual decline to death over the last 50 years. So I like the concept. It makes sense, you know, that limited amount has to be mined. You know, I like all that. I like the fact that we are starting to see the cycles in it. Again, it's not something I would invest in unless I could afford to lose everything that I put into it. But yeah, you have to be attracted to the level of returns that have been there. Some guys have made, you know, I know people who have made a lot of money in crypto. But, you know, ultimately for me, investment is always going to be about what I can control and what I can be involved in, and I like investing in businesses. I like being part of it. I like, you know, analysing a business, pulling it apart and figuring out how we can get the most out of it. I think going forward for us, obviously we've got our various businesses in the property sector. We might broaden a little bit, probably not hugely, but into some of the ancillary services, and I really like the mergers and acquisitions thing. For me, that's where my head's at, because I like being able to influence the result. With a lot of other types of investments, you can't. But again, it's such a personal thing to do. And like I say, you know, I do a bit of you know, investment through Vanguard and trackers, but it's more for the kids than for me.
I think as well, so the next sort of question's more based on, you know, is it important to have more than one investment vehicle? And I think we've kind of answered it, but my stance on it is yes, but you need to be educated. I'm seeing a lot of guys right now on Instagram or Facebook, whatever it is, you know, 1 week they're on this crash course for crypto, the next they're coming to a property event, and you know, it seems to be leveraging the next trend. You know, a lot of people are into AI now, like, let's jump on a course to learn that and how we can monetize that. Do you think it's just get to the point where it's like better to have it? Do you think it's better to have all your eggs in one basket, or do you think it's really important, as long as you're knowledgeable about that certain investment strategy, that you can go for multiple at once?
I mean, diversification is something that's a bit overused in terms of its terminology. It is important because you know, you don't want any one event to be able to wipe you out. There are definitely a lot of course jockeys out there that more enjoy learning about something than actually implementing it. And if you're not going to implement it, what is the point? You know, you have to. There was, I think it was Rob Moore that was talking about it, and I really like this principle of the 70-20-10. So you're spending 70% of your time on your core strategy, the main thing that you're focusing on, and then you're spending 20% of your time on something that you've been working on for a while, that is not completely new to you, but is in its initiation phase and is just kind of likely to become a bigger part of your investment strategy going forward. And then you've got 10% of just things that may or may not land, things that you're just looking into, you know, things that you're learning about that are maybe quite new. And again, it's about, you know, so you've got these three things. You've got your 70-20-10. Once the 70% is to a point where you can systemize it and it can work on its own, that just sits at one side, you know, because it's systemized, it's working. You know, you don't have any great time input to make that work. And that's kind of like a business where we're trying to get the systems in place, we're getting the staff up to speed. You know, you get to a point where you can sit back more as an investor than a business owner that's in the guts of the business every day. And then that 20% can move up to be your 70%, and so on and so forth. And then you've got the opportunity to bring in something new. That in my head is how things work for me. You know, our buy to let is fairly passive just now, so it takes up very little of our time. Real Property Scotland is a business that's growing significantly, so it needs a lot of our time just now. We've got a lot of new staff, we've got a new CRM system in place, we're trying to get it systemised. My hope is that in the next 3-4 years that, you know, gets put aside. I just kind of step back from that business and then I've got something else I can focus on. I like that concept of it because it's manageable, it's structured, it's well thought through. Too many people are just jumping around different strategies, not truly giving any one strategy a chance and the focus that it takes to make something work. So I think it's a really important point. Diversification is great, but diversification also doesn't have to be completely polarizing investments. Even if you look at our business and property, we've had development stuff, and okay, the sales market's not great just now, so the development stuff doesn't really work. But we've got Real Property Scotland where we're helping people build their buy-to-let portfolios. We've got the auction through that business. Okay, the market's not great. That's great for that business because we can get lots of deals. We can be doing lots of auction transactions because things aren't selling on the open market. So even within the frame of property, you can have different strategies in there that you can turn on and leverage depending on the market conditions, and that is the strength of having a diversified business, albeit it's still all within the same industry. No,
definitely. So back when you started your investment journey, how long would you say that ago that was now?
I was pretty late into investment. It's funny because I obviously I trained as a chartered accountant, so I studied finance at university for 4 years and went into a job in finance for a business. But understanding the fundamentals of not spending more than you earn, of building assets, I just didn't get it for a lot of my 20s. I was earning really good money. I worked for an oil and gas company. I travelled the world, but I gave everything to that company. Everything. Full focus, full time, missed birthdays, Christmases. I was always away and heavily involved in some really challenging projects, whether it be kind of Norway, Azerbaijan, Russia. I've been all over with it, and it was a great experience, but it was, I am not focused on myself. I'm focused on the company, and they get my time, and I got paid really well for it. But I made stupid mistakes, like they were paying for my apartment wherever I was living, and I still had a house at home, and I was paying for that. And I still had a car at home that I never used that sat in the drive all the time, and I'm still paying for that. I had a nice shiny convertible Mercedes, or I had a Porsche for a while, and it's like, why did I do that? Because I didn't understand, because I was living in this life of just trying to show I'm doing well to other people rather than the reality of actually be doing well. So it was my early 30s really before I started to get that message, because at that point I was thinking, okay, I'm making a lot of money, like a lot of people that work offshore or they work for oil and gas companies and they're travelling all the time. It's not sustainable when you want to settle down and have kids. So for me it became, right, now I need to get serious about investment and growing my assets, because I don't want to be doing this for the rest of my life. And so that was really the journey from around about 30, 31 to start educating myself, read books like Rich Dad, Poor Dad, Atomic Habits, Richest Man in Babylon, and started to follow all these guys like Rob Moore, Tony Robbins, and just went through a massive education over the course of that 2 or 3 years, and then obviously that led to Root Group and where we're at now. But yeah, I was late, and I think that's why it's so important for me to try and reach out to the guys who are younger, that have an opportunity to start that wealth journey much younger, because it's a much harder job for us to do now. Because again, long-term investment in wealth, the sooner you start, the further you can go. If Laurie and I had started in our early 20s, we could be way down the road right now.
So knowing then what you do now, what would you say people should avoid when making these long-term investments?
What should they avoid? Again, I think the important point is to avoid the expectation of short-term gains. Get rich quick schemes. Even within the property world, there are a lot of people teaching get rich quick schemes. It doesn't exist. It's a fugazi. There are people that have struck it lucky, but long-term investment is about sticking with something for the long term. So it's identify the value, understand it well, and get ready to buckle in, and it's fucking boring because you're just parking the money and forgetting about it. And okay, check in on it every so often, see where you're at, but at all costs you don't want to be flip-flopping with investments. You don't want to be researching 100 different strategies that you could be employing, and then you've seen one of your mates that's just said that, oh, you need to put your money into this, it's amazing. Pick a path and do your best to stick with it. The world changes and we do have to adapt, but you need to understand what is a real event that requires adaptation and what is simply, following the next shiny thing, So, it's such a personal thing, investment, but there are definitely a few things you need to avoid along the way.
Excellent. Thanks very much. I think that's everything that we've covered. Really enjoyed that and looking forward to getting into this more.
Cheers. You're welcome. Gordon, thanks for the questions. Looking forward to seeing how your own investment journey goes and, building those assets. You're certainly in the right place for it because we're talking about it all the time here. This has been the Real Wealth Podcast. I'm Alex Robertson, and thanks for joining us on this wealth journey.